Did you know that trading is very similar to dating when emotions come into play? Just like when in a relationship, emotions can make or break your success in trading. Emotional rollercoasters lead to impulsive decisions and behaviors that could wreck your judgment and rational thinking, leading to disastrous results. Welcome to dooacademy. Today, we'll be diving into a topic that's just as important as investing in the right assets. It's about investing in the right mindset. There's a saying that goes, there are old traders and bold traders, but there are no old, bold traders. While every trader wants to have a long and successful investment journey like Warren Buffett or Sir John Templeton, not everyone has the right mindset and temperament. Without the ability to control their emotions, many have fallen into the trading pitfalls of impulsivity, timidity, gullibility, indecisiveness, ignorance and cutting corners. To thrive in the trading world, you'll need a calm, collected, and proactive attitude. It begins with understanding trading rules and principles, having a clear grasp of your financials and risk tolerance, finding a suitable trading style, and not letting market hiccups rattle your composure. All these, however, are easier said than done, but fret not, we're here to teach you how. At the beginning of World War II, the British government came up with the now iconic and timeless "Keep Calm and Carry On" poster. The idea was to uplift public morale and inspire people to remain composed and carry on with their daily activities despite the difficulties of wartime. The slogan's wise words still ring true to this day and can be applied to every challenge in life, including trading and investment. In other words, trade calmly and rationally. This means making fact-based decisions based on objective market analysis rather than emotion-based choices out of fear and greed. Should you feel your emotions creeping up, think of Star Trek's calm, logical and stoic Mr. Spock, whose actions are ruled by logic and unsullied by emotion. Rookie traders often make the mistake of hopping onto the bandwagon and neglecting proper fundamental and technical analysis. Without the right information and planning, they're like a ship without a rudder when the storm hits, leading them to more misguided decisions caused by emotional turmoil. A wise and seasoned investor, on the other hand, takes responsibility for every trade by having a clear plan with strategic entry and exit points, avoids sketchy stock tips, and says no to reckless impulses to make a quick buck. That's exactly what Mr. Spock would do. The market is an unpredictable rollercoaster, where no trade is 100% foolproof. Many chase after shiny gains while running from potential losses like they are in Pamplona's running of the bulls. To survive the market, your mental fortitude is your most important ally. You need the ability to accept losses and setbacks while keeping strategies that counter losses in your back pocket. Diversification, for instance, is a strategy where you can spread your investments across different assets or markets to keep your overall risk in check and prevents you from solely relying on a single or just a few investments. If, and when losses hit, don't throw in the towel and go into a sad funk. Instead, analyze and reflect on what went wrong so you can improve your strategies and risk management methods for your next trade. Like the name implies, traders can limit their losses by placing a stop-loss order to limit losses or lock in a profit on an existing position. A stop-loss acts like a safety harness, automatically closing a trade when losses hit a predetermined amount, saving you from further losses. For instance, if you invest $1,000 on a stock and can tolerate a maximum loss of 30% or $300, your stop-loss limit will be $700. It's that simple. Choosing your stop-loss percentage depends on your risk tolerance and market trend analysis. So, before investing in any stock, have a clear plan to deal with its volatility. For more volatile stocks, you can stick to a lower stop-loss, while setting a higher stop-loss for the more stable ones. Knowing exactly where your losses will stop can offer some peace of mind to an otherwise emotional trading journey. In the world of investing, wins and losses are like sunny or rainy days, it happens. So be sure to have your umbrella and shades at all times by practicing the right trading mindset and risk control strategies for brighter trading days ahead. Which mindset technique will you practice today? Share your thoughts in the comments below. Be sure to like, share, and follow dooacademy for more actionable investment insights.